any subject, anything you do in life, there's a learning curve. We don't come out of the womb intelligent like Einstein. It usually takes us a year to learn 80% of any subject or skill. It takes 20 years to learn the other 20% of tweaking and figuring out based on results and experiences. In your whole life, you might not have been in an earthquake. You might not have been in a hurricane. You might not have been in a snowstorm because they don't happen that quick is why it takes you so long to learn the other 20%. That and overcoming the small obstacles, getting to where your 80% is defined a little bit better. And that's why it's so important to hone in on things instead of expanding. The better you get at honing in on little things will help define our mental capability from a general idea to becoming an expert. So let's take an if-then-what approach to bear call vertical spreads. So when looking at JPM, we have to follow the process of our trading plan. To do that, we have to make sure we have these 5 things: trend, resistance, momentum, time, and money management. So do we have trend? Yes. Do you have resistance? Yes, but really not right now. So in the if-then process, we have to think, is there another if-then-what that makes this a good entry point to be up against resistance? From these lows up to the highs, we do have an impulse wave, and that's where patterns could come in, like this being a head and shoulders. So do we have resistance? Yes. Are we away from support? Yes. But in a head and shoulders pattern, we know that it would make a range box duplication. So are we far enough away from this support level? And the answer is yes. Another way to see if the trend is changing, duplicate this channel up, and you can see we came into this completion. Another way we could see that we're in this resistance here, which defined the channel here. Price broke up, which is a downtrend, and currently is going up to retest. So if we enter the trade right here, then it goes higher into this resistance or double top, then we could take another trade. And all of this is important when picking the option. Obviously, with this unknown area, we don't want to spend too much money because we might have to double at a higher high. The other problem we run into is right now, JPM is $162.41. And why is that a problem? Because JPM only has $5 wide strike prices, meaning I can either have my lower strike price, the calls that I'm selling, at 160 or 165 or 170. I'm pretty confident I can easily get into this trade because price is above this lower strike. But that means price has to come below, putting demand on the value to come down, this $160 to make our profit. Now, they're not going to just give me this strike price at a 1-to-1 ratio. So if then, I have to raise it up and price would have to come higher to get me into that trade. And obviously this strike price for my lower call option that I'm selling would be the hardest or maybe take the longest time because I have to wait till price comes above it to get me into that 1-to-1 trade. Then I would buy the 175 for protection. For now, we're just going to do an if-win process on these two here. So when we're looking at these two scenarios between where the current strike price is, we have a choice if we're getting in at the money. If we pick the lower than the current stock price as our strike, I would say be more conservative, meaning move your risk to reward up so that you're not risking as much as your reward is. Versus if you were going with the higher strike price, demanding that price comes higher, maybe be a little bit more aggressive because you know you're getting it at a higher strike price. So let's look at it. If we were to use the lower one, 160, and price is currently at 162 on a $5 spread, that's what I mean. You can be more conservative. You can ask for a higher than a 1-to-1 ratio. On a $5 spread being at $2.60, that gives you max loss $240, max profit $260, with your break even right where price is now. Good, good, and good. But we're talking about being a little bit more conservative because price has to come down from 162 to 160. So why not increase this because it's above your lower strike? Even just moving it 10 cents higher, meaning you're preserving some of your capital, moves you down to $225 instead of $240. It increases your odds to $275 profit versus $260. And it increases your break even up to $162.75. Now let's look at the higher strike price of $165 to $170. $5 spread, and you can see they're not giving you much. At $1.75 on a $5 spread, you could see you're risking a whole lot more to make less than a 1-to-1 risk to reward at $175. But since price is at 162 right now, break even at 166.75 is awesome, but not good enough for us. For us, when doing a $5 spread, we have to go right in the middle at 250. Even though we're using the higher strike price on the options, this is the rule. $250 risk, $250 loss, and even notice we went from $166 up to $167.50 because we raised this up. But this is what I mean by being a little bit more aggressive. Instead of making sure at this higher strike price that we have to meet the 1-to-1 rule, a little bit aggressive would be if you were under that 1-to-1 rule at $255 risk to $205 reward, which lowers down your break even only of 5 cents. Don't come off of this number too much though. Because even if price comes into this 165 strike and gets you filled, on the if then what process, price could go all the way up here to 175 before it comes into more resistance. And then you start the process over with new strike prices. Sometimes when doing the if then what on price and strikes for the options, you'll run into things like this. BYSI came into resistance, but it only has $5 strikes. So if I take this lower strike price, sell calls there, and buy the higher strike price for protection, that means I have to have price come below this $25 for me to make a profit. Now, there's definitely a lot of room for this thing to be able to go. But if I pick this lower strike price of $25, that means it will have to move at least 13% for me to make money. That's a big move. I know, it did 13% today, but when you have money at risk, it's something to consider. If then what? More so than a double down on dog. D-Dog's right in the middle of strike price at $133.45. So we're either going to take the $130 strike, the $135 strike, or the $140 strike. But let's see what it would be like if we took the $130. First of all, we would only need price to move down 4% instead of over 13. That's 200% less than what we're asking of the other one. So on an if-then thought process, which trade would you rather get in? The one that demands that price has to move down 13% or the one that demands that price only has to move down 4%? Not all trades are equal, even though the concept of up against resistance and bear call spreads are seemingly the same on both. There's a different demand on the way the strike prices work. But now that you have the ability to think through this process of if then on where price is, where price has to go, picking the right strikes. Should you be more conservative because price is over top of that lower strike? Or should you be more aggressive because price has to come up into that lower strike to get you in? Either way, now mentally you can think about this process when choosing which ticker to get into and what strike price will give you the best results.